Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation was given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation we are demonstrating hypothetical computer simulated trades. They're believed to be as accurately represented as possible. Keep in mind the live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, financial freedom, and success coach with Lock in Your Success LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today I'm here to take you into the realm of something called high probability options trading. It's also referred to as income trading. And this is where we use option strategies to take advantage of the passage of time rather than depending on price movement alone in order to make money. Now, this doesn't mean we're going to win all the time, but it does mean that we can often make money whether the market goes up, down, or sideways. The strategy that we're going to be covering today is something called the bearish butterfly. Now, the bearish butterfly is a strategy that tends to do very well in the types of markets that we've been having over the last year. Now, in fact, if you take a look at the record of the bearish butterfly, we have won every trading cycle for the last 12 months. And over that 12-month period, we've had a trade-for-trade return of approximately 182%. So fantastically well in this choppy and slightly downtrending market that we've been having in the Russell 2000 over the last year and is expected to continue to do well. And if you go back to some of the past examples that we've had with the bearish butterfly, you can remember that I told you months ago that we were transitioning into a market where this type of strategy is going to do very well, and that has proven to be the case. So very happy with that performance. So a little bit more about the bearish butterfly for those of you who haven't seen it before. It's a strategy that we trade on the Russell 2000 index. It takes advantage of a variety of markets, such as an overextended uptrending markets, volatile and very volatile sideways markets, as well as volatile downtrending markets and smooth downtrending markets. It requires a minimum of $5,000 per trade. Although in this environment, we don't get anywhere near that much capital in the trade, but we figure our profits and losses off of that number anyway, because that's what we set aside for it. We have a high profit target of 30% of our planned capital in our trades, which is $15,000. If the trade gets what we call 21 days to expiration, which we will explain later, we have a reduced profit target of 10% of planned capital or $5,000. And if things go poorly, we have an exit loss trigger of approximately 30% of our planned capital. So let's take a look. For those of you who are new to us, this is an analytical software called Optionnet Explorer. It can be found at optionnetexplorer.com. And what this does is it shows us the profile of our position. When you buy a stock, you pretty much understand that if the price goes up, you make a certain amount of money. If I have one share of stock and the price goes up $1, I make $1. You don't really need an analytical graph to figure that out. But when we start going into complex options positions where we have options on at multiple strike levels, that can be a little bit confusing to understand when you're going to make money and when you have risk on the line. So that being the case, this software is very helpful. And what this is showing us is this is going to be our profit and loss profile. So the sharp edge line we have here on the graph is what we call our expiration graph. So when our options expire at any given price point of the Russell 2000, this is what it would be worth should we do nothing and should we expire the position. Meaning that if in, let's see, right now we are 57 days to expiration. So in 57 days, if the price were up here at 2,300, we would be down $5,000. If the price were here at about 2220, we'd be up about $43,000. Now, neither one of those are going to play out because we're going to do something called adjustments as the price moves around and so forth. But that's what the graph here is telling you. Then you have this curved line known as your T+0 line, and this is giving you the approximate value or the approximate profit and loss in your position as of today at any given price point. So if the Russell were to jump down to 2,100 today or on the day of this graph, then we would have a profit, or it would be a projected, it's projecting we would have a profit of about $1,350. So that's what that analytical graph means. Again, the asset price is along the bottom, profit and loss on the right column here. Over on this side, this gives us our asset. This is the date that we're currently checking and the time. And I'm just going to jump back to 15:30. 15:30 is 3:30 Eastern time, half an hour before the market closed. The date we opened the trade was December 23rd, 2021, so just before Christmas. We are 57 days to expiration. At the top, we have our call options. At the bottom, we have our put options. These are the strikes of our options. What we're going to do is we're going to take a look at our asset price. It's 22.41, and we're going to go about 20 points under that, and that's going to be approximately 22.20. We're going to sell short strikes here, and we're going to do something called an iron butterfly, which just basically means we're doing a vertical spread in the calls and a vertical spread in the puts. They both have the same, what we call short strike, or the strike that's negative, or the strikes that we sell. So here we're going to sell 22.20 calls. We're going to sell 10 22.20 puts. We're going to buy 10 22.70 calls. We're going to buy 10 21.70 puts. That's going to give us our iron butterfly. And we're going to do this in one order. We don't do the options all at the same time. Any brokerage that is good with dealing with options is going to have an option to what we call sell an iron butterfly, which is what this would be doing. And that's going to give us an analytical graph that looks like this. And that is where we start. Now, remember we said we had a $50,000 planned capital. That's because we do something called adjustments, and we do also a scaling in sequence. So this is what we call a scaling in entry, and we scale in by price. This is what we look like at the start. We'll add in, if we go 40 points, of what we call our reference point. So we have a reference point when we enter, which is our short strikes. We go 40 points over that. We're going to add another iron butterfly in. If we go another 20 points over that, we're going to add another iron butterfly in. And then from there, we no longer add to the position, but we start rolling the position, which can also increase the cost in the position. In a low implied volatility environment, these butterflies are much more expensive. So that being the case, we have more capital. In this environment here, you'll see our capital stays very, very low, even if we have multiple rolls. To the downside, if we start having too much downside risk, then we will roll this to the downside. And we'll talk about that because this one has multiple rolls to the downside. So when we start here, again, you'll see we have a very narrow profit and loss tent. But as this moves along, this tent moves around, it gets wider, it gets more narrow, depending on what's going on in the market. So let's show this example, and we will go to the first adjustment. So here is, again, December 23rd. If I go to January 3rd, let's talk about what happens here. So we have a reference point on this, again, of 22.20, and that's because we have our short strikes here. We're going to add to the position if the market goes up. So here, the market went up to 22.68. 22.60 is our add point. Now, we don't look at this position intraday. This is one of the positions, or most of our longer term trades, we're not looking at in the middle of the day, meaning that you can basically trade this if you have a job. You can trade this if you're in a different time zone. And basically, we have a checkpoint time. It's 15:30, half an hour before the market closes. We come in, we look at the position. Where's the asset price? Oh, wait a minute, it's 22.68. That's over our scale-in point here. So I'm going to go in and put in another iron butterfly. And this time, I'm going to put it in here 20 points higher than our previous one. So I'll do it there and here. And that is going to be our new position. So let's clear that. We'll show this coming in. And by the way, this is our profit and loss where the market went up, but we're still up $320 approximately here. And we've scaled in to our position here. So from there, if we go too far down, what was going to happen? So say we the market reverses. If we go too far down, we're going to eventually scale out of our initial butterfly or our butterfly that we just added here. And then if it continues to go down, we roll the position back. So we don't increase size on the down moves. We only increase size on the up moves. So that's our first increase here. And let's see where we go from here. By the way, if we look at the price charts for the last year, we were talking about how well this did over the years. The price has been very choppy and very sideways. This can be difficult to make money in a directional market. I mean, if you just buy something and hold it, you're pretty much treading water here. You know, occasionally it pops up and sometimes it pops back down again. Depends whether you bought on the high or the low, that type of thing. This here is much different. It actually loves this environment because you'll see the way that, that this reacts. So this is where we are now. And let's just go to next adjustment. So it's January 4th here. So we sit in the market for about 10 days and we ended up getting a fairly substantial down move here. And in a position this size, we allow about 20 positive delta. We're currently at 20 positive delta, so where we're over 20 positive delta. So that's all we allow for delta on this. So what I'm going to do is I'm going to pull out of that butterfly that we put in to the upside. And that's just going to sell that off. And our position is going to look like this. You can see it brings our delta to pretty much flat delta. And I don't think I have to do a rollback. Hold on. So actually I did two moves here. This will be the first thing that we try if the market goes too far down. When I'm in 2/3, I am allowing a positive 20 delta. When I get into 1/3, we change the guidelines a little bit, and we really don't allow very much positive delta at all. So in this case here, we pull out the upper butterfly, and here we're still positive delta. So what I'm going to do is, and by the way, for those of you who don't know what the delta number is, the delta number is the amount of money the position is likely to, or is projected to win or lose with a $1 price movement. So if I'm at 20 delta and the market goes up $1 or the Russell goes up $1, this is saying that we should make $20.48. It doesn't turn out that way exactly, but it gives us at least an approximation. And if we go down, then we're likely to lose $20.48. And what we're doing is we're shifting our delta to near neutral. If we're zero delta, the price movement risk tends to go away. We still have what we call implied volatility risk, but price movement really isn't much of an effect. But anyway, we're too positive still. So what we're going to do is we're actually going to sell out of the whole position here. I'm going to sell the whole butterfly off, and we're going to move back to, in this case, we move back to put our short strikes at 22.10. That gives us relatively neutral delta. So we're basically minus 0.36. So when we're negative, by the way, delta, if the price goes up, you lose money. At least that's what it's projecting. If the price goes down, it's projecting you're going to make money if we're negative. So this is where we are. We're sitting at $4,700. We're 35 days to expiration. So we've been in this about 22 days or something like that. And we're looking good. Also, the other thing I want to point out, our capital in this here is at this point about $11,000, much less than $50,000. When we make our adjustment to the downside, we tend to pull capital out. Now our capital after this adjustment is only $3,200. So let's move to our next adjustment. So here's the 18th. What happens? Well, we end up getting a 53-point down move here actually, if you look at the price chart, we just continued. We had a little couple days of consolidation, then we had 1, 2, 3 days of hard down movement. We end up getting positive 13 delta, which is with a 1/3 of a position is too high. So what we're going to do is we're going to roll this back again, and we're going to roll it back to essentially neutral delta. So here, what I'll do is I'll come in and I'll check my 2180 butterflies. I'll check my 2170 butterflies to see where I'm basically as neutral as I can get. And in this case here, we move from the 2210 down to the 2180. And now we are flat delta once again. And we're good to go. So let's go to next adjustment, again, the 18th. Very next day, we get another 25 points. Our delta gets high. So we're going to do the same thing. We're going to move our 2180, in this case, down to 2140. That gives us relatively neutral delta, 16 cents. So this is where we are. Again, price chart, we're basically in a market, a very hard market down move here. And we are now 30 days to expiration. I talked to you earlier, I was going to tell you what that meant. So DTE, they call it, or days to expiration, is how long the option is essentially good for before it settles. So options have a time factor to them, which is why we can make money over time. You're paying essentially what a lot of people call time premium on an option. And we're going to sell some time premium when we sell our short strikes here. We're going to buy some time premium when we buy our long strikes. We're selling more than we're buying. And that gives us our expiration graph. In other words, when we're sitting here in this position, when all the time premium comes out of the options, this is what this option is worth at the 2140 price level. And these are, back here is what the options would be worth at or valued at for profit and loss. They were to lose all their time premium overnight, but they don't because we still have 30 days left. And that's what we mean by we're taking advantage of the passage of time because we're letting our time premium decay, which is, when you get more factual about it, is really implied volatility, but we will call it time premium because that's what most people call it. So anyway, this is where we are here. And it's the 19th of January. Let's go to the 20th. So now we're adjusting fairly regularly. Again, this is because we're in just a fairly constant down move here. But it's only once a day, and we're only looking at it once a day. So here we're at 2140, 2 positive delta. I'm going to bring this back to relatively neutral. Now we're minus 1.26, and we're down at 2111 with our short strikes. Go to next adjustment. The 21st, again, we're continuing down. We're at 1256 positive. We're getting rid of our 2110s, and we're bringing this down to 2060. So here's our new position. And let's go to next adjustment, which is a 26. So this is 5 days. We're continuing down. So here we are, positive 326. Just flattening again to neutral. Now our short strikes are down to the 2050 level. If we look at our price charts, the market's just going down, 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 down. Go to next adjustment here, which is the 27th. We get a 45-point down move. Our strikes are up at 2050. Delta's too high. Down to 2,000 strikes. This is our new position. Again, look at the price chart. We're just continuing this down move. At some point, the price does reverse. So let's take a look. So we're 22 days to expiration now. If I go one more day here, we did get we actually did another down adjustment. And this is one of the interesting things with these types of trades. The market actually went up from the previous day. It's actually higher, but our position's more positive delta than it was. So this is going to call for a rollback anyway, even though the asset price actually went up here. So I'm going to roll back from 2000 to 1980. We're relatively neutral delta. I'm actually -4. I think I had a choice between -4 and +7. So again, we go for the flatter delta. So, and we tend to favor the negative a little bit. So we're at -4 here on this. And now we're at 21 days to expiration. So if you remember, we had a profit target of what, 30% of planned capital, and that was going to be $15,000. And even though we only had $11,000 in the trade, by the way, so far, and at 21 days to expiration, we're going to reduce our profit target. If I'm still in this at 21 days to expiration, it basically means the trade's not going as well as it should be. So we want to get a small amount of our profit basically and get out, and that's 10% of planned capital, or $5,000 in this case. So this is where we sit. Let's look at the reversal, which I believe comes up next. So it's January 28th. So the very next trading day, and we get this, right? We get these large capitulations in the marketplace. So what ended up happening is we got this V reversal here in the marketplace. We have a new reference point because we rolled our position back. Our new reference point is 1980. And again, we scale in when the market goes up. So the market has gone up. I'm going to scale in at 2020 and 2040. The asset price is at 2045. So here's our scale in. We're going to add butterflies at 2000, and we're going to add them at 2020. So you can see those come into line here. Now our capital's higher. We're at about 18,300, we'll call it. And you can see this is the most capital we've actually had in the trade since we've begun. Let's move forward here. So this is what happened on February 2nd. We got a little bit of a pullback here, and with that pullback, our profit is now 63.60. That is greater than our $5,000 profit target that we still go for under 21 days to expiration. So we're simply going to close this trade out, and we are going to continue to trade what we call the next cycle. So this trading strategy does overlap. It starts 56 days to expiration. It could go as far as 0 days to expiration. So we do overlap trades, and the overlapping trade actually looks like this on that here. And then, of course, we trade out our March position, which did win, by the way. This March one actually makes for 13 months in a row of gains in the strategy. And the April trade, as of this point, looks like it's going to probably do fairly well also. So really loving this strategy right now. Thought I'd share it with you. And I hope you got a lot out of the video. And that is the Bearish Butterfly, this episode's winning trade. If you like what you see, I encourage you to come on over to thewinningtrade.com and check out our Go membership, where you can follow along with this and 12 other trading strategies as they unfold during our weekly Options Trading for Income webinars. Also, where you can learn about upcoming winning trade presentations, and you can explore past winning trade presentations. And perhaps best of all, you can check out our free trading performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, I invite you to make those comments on the video below, and I'll answer your questions for you personally. Thank you for joining me, and I look forward to seeing you on the next winning trade.